Buying a home when you're self-employed is absolutely possible, but it does work differently. Today I'm going to walk you through exactly how it works, what lenders actually look at, and how to avoid the biggest mistakes I see self-employed buyers make. I'm Mike Hengy, your mortgage mentor. Let's make this simple. Here's the biggest myth. Self-employed buyers can't qualify. That's not true. The real challenge isn't qualification, it's documentation and timing. Lenders don't dislike self-employed income. They just need to see it clearly, consistently, and conservatively. Once you understand that, everything changes. If this kind of clear mortgage guidance is helpful, subscribing makes sure you see more videos like this. When you're self-employed, lenders are really asking 3 questions. First, is the income stable? They typically want to see at least 2 years of self-employed history. 1 year can work in some cases, but 2 years is the standard. Second, is the income consistent or increasing? Flat or rising income is usually fine, but declining income raises questions. Consistency matters more than peaks. Third, what is your usable income? This is the part that surprises people. Lenders don't use gross revenue. They use net income after expenses, which means the more you write off, the lower your qualifying income may appear on paper. That doesn't mean you're doing anything wrong. It just means planning matters. This is where planning ahead makes a huge difference. For most self-employed buyers, lenders review 2 years of personal tax returns and 2 years of business tax returns. Depending on how your business is structured, that could include Schedule C, K-1s, 1120S, or an 1120. Smart tax planning isn't always mortgage-friendly tax planning. You don't need to stop writing things off. You just need strategy and good timing. I see self-employed buyers make these common mistakes all the time. Applying before reviewing their tax returns, assuming gross income is what lenders use, switching business structures mid-process, making large deposits with no paper trail, and waiting too long to talk to a lender. None of these are deal killers, but they can delay things, add stress, and create confusion that could have been avoided. There are multiple options you may not know when it comes to loans. Not all loans are created equal. Depending on your situation, options may include conventional loans using tax returns, bank statement loans, asset-based options, and other non-QM programs. The best option isn't always universal. It's personal, and it always starts with understanding your full financial picture and not guessing. If you're not buying immediately and planning to buy in the next 6 to 18 months, I have 5 recommendations you should do. Speaking of what you should do, if you ever need anything or have questions, I'm happy to help. I love making the mortgage process more clear. If you're planning to buy, here's what I'd recommend doing now. Review your last 2 tax returns, talk to a lender before filing your next one, keep your business and personal accounts clean, avoid major structural changes without guidance, and clearly document any large deposits. A little preparation here can save you lots of stress later. I've helped many self-employed buyers purchase homes, even after they were told no elsewhere. Being self-employed doesn't make you unqualified. It just means the path is different. The planning matters more, and clarity early saves stress later. The difference is almost always understanding the rules before applying. Most buyers regret the payment they didn't think through. If you want to know how much housing you can actually afford, watch the video on the screen. If you're wondering what's possible or how close you really are, reach out anytime. I'll walk through your numbers, your income, and your timeline in plain English. No pressure, no judgment, just clarity.